A single oil shipment froze at the port, not because of sanctions, not because of politics, but because no one trusted what would happen when the money moved. That moment of hesitation just rewrote the rules of global trade, and most people will never hear about it. Picture this: everything is ready to go, the contracts are signed, the approvals have been issued, the payment is set to transfer. But then, nothing happens. The oil stays locked in storage, the ships remain docked, the deal dies. Not from a missile strike, not from a diplomatic crisis, but from something far more dangerous: doubt. Somewhere in the global trading system, a buyer and a seller stopped trusting that the financial infrastructure would hold up once the transaction went through. No one made an announcement. No headline captured it. But that single moment of hesitation rippled outward, tying up supply chains, freezing capital, and quietly shifting the foundation of how the world does business. This is not a story about war. It's a story about something far more fragile: confidence. And right now, in Washington, Beijing, and Caracas, that confidence is being tested in ways that could reshape the global economy for a generation. In the halls of the U.S. Treasury, Scott Bessent is not a man who concerns himself with optics or public relations. Those who have spoken with him, as reported by Bloomberg, describe a laser focus on one uncomfortable question. What happens when the financial tools we've relied on for decades stop working the way they're supposed to? The United States has leverage. It has sanctions. It has enforcement mechanisms that can freeze accounts, block transactions, and isolate entire nations from the global banking system. But here's what it doesn't have: the ability to force an oil project to be profitable. It can't legislate investor confidence. It can't make a broken industry attractive just by issuing permits. And yet the Trump administration has decided to move forward anyway. Venezuela is sitting on more than 300 billion barrels of proven oil reserves, more than Saudi Arabia, more than Iran, more than Canada. In fact, it has more than 10 times the reserves of China. On paper, the logic is almost irresistible. Restore production, flood the market with supply, drive prices down, secure cheap energy for American manufacturing and the booming data center industry. At the same time, deny competitors, especially China, access to affordable fuel. In a PowerPoint presentation, this strategy looks like a masterstroke. In the real world, it looks like a financial trap. Industry analysts, cited by Reuters, estimate that rebuilding Venezuela's oil sector would require at least $10 billion per year for an entire decade. And that's, the optimistic scenario, one that assumes everything goes smoothly, that security holds, and that infrastructure still works. Engineers who have examined the situation, speaking to the Financial Times, believe the actual cost could be double or even triple that figure once you account for the full extent of the damage. The pipelines are corroded, the drilling platforms have been abandoned, the refineries are operating at a fraction of their designed capacity. Years of sanctions didn't preserve this industry. They gutted it. What's left is a skeleton. And honestly, rebuilding it will be extraordinarily expensive. But the challenge goes deeper than just infrastructure. The oil itself is the problem. Venezuelan crude is exceptionally heavy, some of the thickest, most difficult oil in the world to extract and transport. Compare it to Saudi crude, which flows easily and refines into high-value products. Or American shale, which is light and versatile. Or even Russian oil, which sits somewhere in the middle. Venezuelan crude is at the extreme end of the spectrum. It's so thick that it requires chemical dilution just to move through a pipeline. Yes, American refineries can process heavy crude. But it costs more. And if the goal is to export this oil to global markets while ensuring it doesn't end up in China, the logistics become even more complicated. This is why Venezuelan oil has always sold at a steep discount. That discount isn't political, it's geological. You can't change it with policy. This reality explains why major energy companies are staying on the sidelines. ExxonMobil has been unusually direct. CEO Darren Woods, in remarks reported by the Wall Street Journal, made it clear Venezuela is not investable without sweeping reforms. He pointed to the absence of enforceable contracts, reliable legal protections, and a functioning judicial system. Exxon has been burned before. Its assets were seized twice in Venezuela, most recently under Hugo Chavez. Entering that market again would require guarantees that no government, no matter how friendly, can realistically provide. Even deploying U.S. military forces or private security contractors wouldn't solve this. Oil projects last for decades. Political promises rarely last beyond a single election cycle. That mismatch is fatal to long-term investment. And this is where Bessent's concern becomes acute. If private capital refuses to flow into Venezuela, the financial burden shifts to the government. Through subsidies, loan guarantees, and indirect exposure ultimately borne by taxpayers. Treasury officials understand exactly how bond markets would react to that scenario, especially at a time when the United States is already grappling with massive deficits and record debt issuance. The response would be swift and brutal. So Washington is adjusting. According to Reuters, the administration has begun selectively easing sanctions on Venezuela, issuing licenses that allow limited oil flows under U.S. supervision. Publicly, this is framed as pragmatism. In reality, it reveals how sanctions actually function. They're not permanent walls, they're adjustable valves. When they start threatening domestic economic stability, they get recalibrated. Oil is allowed to move again, but only through channels Washington can monitor and control. Meanwhile, the United States is escalating pressure on China in an arena that carries even greater structural risk. Peter Navarro, one of Trump's key trade advisors, is pushing for a renewed campaign to break China's dominance over critical minerals. The rhetoric may shift, but the goal is unmistakable: economic separation at any cost. China controls nearly 90% of global rare earth refining capacity. According to data from the U.S. Geological Survey, these materials are embedded in everything: electric vehicles, wind turbines, advanced weapon systems, semiconductors, and data infrastructure. There's no strategic stockpile large enough to absorb a disruption. If supply gets cut off, shortages appear within months, sometimes weeks. Internal U.S. government modeling, reviewed by the New York Times, lays out the impact in stark terms. For several minerals where Chinese processing dominates, a supply cutoff could trigger direct losses ranging from $1 billion to $5 billion per mineral. And because scalable alternatives don't exist, there's little room to mitigate the damage. The secondary effects would cascade across manufacturing, defense production, and technology supply chains. Japan knows this dynamic intimately. Officials at its Ministry of Finance have publicly described reliance on Chinese mineral supply as a strategic vulnerability. Years of effort to diversify have reduced exposure somewhat, but haven't eliminated it. Accelerating that process would require massive public spending at a time when debt markets are already absorbing unprecedented volumes of bond issuance. Consider a quieter example: a Japanese electronics manufacturer. When rare earth supplies tighten, factories don't immediately shut down. Instead, output slows, inventories shrink, delivery schedules slip, prices quietly adjust. By the time the disruption becomes visible to the broader market, the economic damage is already locked in. And that's where Venezuela suddenly becomes relevant again. If the United States is about to spend enormous sums rebuilding mineral supply chains independent of China, pressure builds across the entire cost structure. Energy becomes the one variable that cannot be allowed to spike. Venezuelan oil, thick, discounted, and difficult to refine, has become less of a genuine energy solution and more of a political pressure valve. Its value isn't rooted in efficiency, it's rooted in leverage. And that leverage connects directly to the global currency system. Energy trade creates demand for currency. For decades, the US dollar has benefited massively from the fact that oil is priced and settled in dollars. When sanctions fracture markets and push producers into side agreements outside the traditional banking system, that foundation weakens. China has already moved aggressively to expand oil transactions settled in yuan. Venezuela itself has experimented with alternatives to dollar-based trade in the past. By maintaining control over Venezuelan exports, Washington slows that drift. By easing restrictions selectively, it attempts to preserve dollar-centered energy settlement. This operation isn't about flooding the market with supply, it's about buying time. China sees the signal clearly and responds indirectly. Instead of matching pressure with tariffs, Beijing has tightened its grip on silver exports. Recent customs disclosures reported by Bloomberg show that export permissions for 2026 and 2027 have been concentrated among just 44 approved firms. Smaller players have been pushed out of the system. This isn't an outright ban, it's control over access. Silver is no longer just a store of value or an industrial commodity. It's essential to solar panels, electronics, and advanced manufacturing. By narrowing export pathways, China gains flexibility. Supply can be redirected inward, quietly, without announcements or retaliation. Markets have already sensed the shift. Silver prices have surged over the past year, reaching levels well above historical averages. Volatility has intensified. Physical premiums, the extra cost to acquire actual metal rather than paper contracts, have expanded. Financial institutions are scrambling to adjust. HSBC has raised its long-term silver outlook, noting that current prices already reflect supply stress linked to trade tensions. What remains underappreciated is the structure of the market itself. Paper contracts for silver vastly exceed the amount of physical metal available. Claims on silver outnumber real ounces by extreme margins. That imbalance fuels volatility, and volatility discourages long-term ownership. For decades, this system favored financial intermediaries, but China's tightening challenges that arrangement. Paper promises cannot indefinitely compensate for physical shortages. As the United States applies pressure to mineral supply chains while simultaneously leaning on controlled oil flows to suppress energy costs, financial markets are being forced to absorb multiple shocks at once. Budget gaps widen, debt issuance grows, confidence in currency stability erodes, demand for hedging increases. This isn't systemic collapse, it's compression. The visible operation may have ended. Helicopters departing Caracas, officials shaking hands for the cameras, but the real struggle has already moved elsewhere, into shipping schedules, refinery economics, licensing frameworks, and currency settlement mechanisms. Energy companies may still choose to stay out of Venezuela. If they do, Washington absorbs reputational damage without securing durable supply. If they enter, they'll demand guarantees that strain public balance sheets. If China responds through materials rather than traditional trade barriers, markets will register the impact immediately. The petrodollar doesn't disappear overnight. It erodes quietly as transactions shift from trust-based systems to enforced compliance. The real risk isn't a public failure. It's a silent success that hides its cost until the system itself begins to resist. In recent weeks, maritime insurers in London and Oslo have quietly increased premiums on shipments involving Venezuelan waters, not because of sanctions exposure, but because contractual reliability has deteriorated. When insurance costs rise before a single barrel even moves, traders begin treating that supply as hypothetical. This alone limits how much Venezuelan oil can actually influence global prices, regardless of how many waivers or licenses are issued. Shipping data from European ports reveals another shift. Large tankers are increasingly avoiding Venezuelan terminals, replaced by smaller, less transparent vessels. That change raises transportation costs, increases environmental risk, and reduces overall capacity. Oil that looks cheap at the wellhead loses its advantage when logistics become inefficient faster than production can expand. Refiners are reaching similar conclusions. Margins on heavy crude are tightening as environmental compliance becomes more expensive. Upgrading facilities to handle ultra-heavy blends competes directly with investments needed for electrification and emissions reduction. Executives aren't weighing ideology against profit. They're deciding whether to lock capital into assets with limited future flexibility. Venezuela represents constraint, not opportunity. All of this is unfolding as dollar funding conditions become less stable. Federal Reserve data shows offshore dollar liquidity growing more volatile, with intermittent spikes in short-term funding costs in swap markets. As energy trade becomes more complex to finance and settlement risks increase, the dollar's structural advantage weakens, not through a dramatic break, but through gradual fraying. China understands this moment perfectly. Its approach to minerals is deliberate rather than dramatic. By avoiding sweeping bans and instead tightening control over who can export, Beijing forces buyers into longer commitments, higher advance payments, and political negotiation. Trade drifts away from open spot markets and toward managed flows that favor currencies supported by centralized coordination, rather than purely market-based systems. Silver is central to this transition. Unlike oil or rare earths, it cannot be easily replaced. It can't be recycled at scale. It can't be manufactured synthetically for critical applications. Defense contractors, solar producers, and electronics firms all compete for the same limited supply. When export controls collide with a market dominated by paper leverage, physical delivery becomes the breaking point. That's why volatility rises even when demand projections appear unchanged. There's also a sequencing dilemma. If Washington increases pressure on China before securing stable energy buffers, inflation risks resurface faster than policy tools can respond. If it delays mineral separation to keep prices contained, strategic dependence deepens. Venezuela was supposed to ease that tension. Instead, it highlights it. The more subtle risk is reputational. When sanctions tighten one month and loosen the next, counterparties stop treating policy as durable and begin treating it as tactical. Negotiations shift away from rules and toward raw power, and power is expensive to sustain. What follows is not a dramatic end to the petrodollar, but a narrowing zone where it functions smoothly. Beyond that zone, trade splinters. Settlement becomes conditional. Insurance replaces trust. Hedging replaces investment. They are signals of a system being pulled from multiple directions at once. Systems under strain don't always snap. Sometimes they simply lose the ability to return to their original form. And that may be the most dangerous transformation of all. One that happens so gradually, so quietly, that by the time we recognize it, the world has already changed.